Good morning, ladies and gentlemen. It gives me great pleasure to welcome you to Hawksmoor's first virtual Advisor Roadshow, and I'm absolutely delighted you can join us on this auspicious occasion. COVID-19 has completely changed the way the industry operates, and I'm pleased to say we moved the whole firm to working from home very quickly and seamlessly back in March, but mostly thanks to great current technology. And it is thanks to this technology that we can host this conference today and reach far more of you than we would have ever been able to do had we been in a single physical location. My name is Sarah Saw, and I am the CEO of Hawksmoor, having joined in October last year and formally appointed on the 1st of January this year. I've had 35 years in the wealth management industry, 29 years with Brewin Dolphin, carrying a variety of roles, including investment manager, before moving on to full-time management. I was the first female director on the main Brewin Dolphin board, and I had 6 years with JM Finn as head of investment management. I'm absolutely thrilled to be part of the next exciting phase of Hawksmoor. I'm absolutely delighted to join a firm with such great culture and work with really wonderful people. I was attracted to the firm by its client-centric approach, and we are first and foremost here to support you and your clients for all your and their investment requirements. And our focus is to do what we do as well as we possibly can. There are two areas of our strategy which I particularly want to focus in on. The first is diversity and inclusion. I feel passionately that we should increase the diversity not only of our client base, but also of our staff. And secondly, sustainability. It's not just the way we invest portfolios, but it's also the way we run the company. And we will be developing this in the months and years to come. I hope you enjoy our presentations. Please feel free to ask as many questions as you like through the Q&A button, and we will endeavour to answer as many as we can at the end of the sessions. I would now like to pass you over to our three presenters today, who are Jim Wood-Smith, our Chief Investment Officer, who's going to talk about world markets. James Clark is going to talk about sustainability, and Ian Woolley on the AIM portfolio service and the fascinating world of video gaming. I will now pass you over to Jim, and he will give you the results of the first poll. Thank you. Over to you, Jim.
Right, thank you, Sarah, and a very good morning to everybody. If this all goes as it ought to, the results of the poll should be popping up on screen. As we speak, I don't have them on mine. Are they coming? Ah, here we are. No, I've got the vote button, I haven't got the answer. Right, 50% even higher, 50% about the same. Nobody on the poll has said that they are going to go down. Jolly good. Right, I know my audience. Right, for those who know me, I'm Jim Wood-Smith, and I am Chief Investment Officer at Hawksmoor. It is lovely to see everybody again, even if I can't actually see you. Thank you for joining us. The task for the next 20 minutes is to explain our take on what has happened on what we might euphemistically call an interesting year so far, to explain where we think that markets have got to, and most importantly, where we think that we are going to go to. So let's just have a start by looking at the first half of the year in some numbers. And so we've got a selection of asset classes. And on the right-hand side, the right-hand column, you've got the performance during the first half of the year. And with one notable exception, knowing what we know about what's happened in 2020, I think we can reasonably look at those numbers and say they're not that bad. They could have been a great deal worse. So the standout is probably US equity, where the US equity markets are pretty much unchanged. But also highlight the gilts line, where gilts have provided a positive return of 6% in the year so far. And one of the features that we've seen has been that the safe havens have actually acted as safe havens. So we've got the gilt number there. We haven't got the gold number on screen, but the sterling return of gold in the first half of the year is about 25%. So safe havens have done their job. The standout on the downside is UK equity, and we'll do a little bit on UK equity and a little bit on the UK, and why that minus 19% might actually be quite well justified. So having looked at it in the shape of a table, let's see what a line looks like. So there's the performance of the US equity market during the last year, with the progression of the lockdowns superimposed on it. And let's get the lockdowns over and done with at the outset. Lockdown economically is the most catastrophic economic policy that hopefully any of us will ever see. The damage to economies by lockdown is massive. And again, we'll look at some numbers on that a little later on. But what we can see on this chart is that end of last year, start of this year, through most of January, that 10-year long bull market is still going strong. Then we get to the Wuhan lockdown at the end of January, and there's a little bit of a wobble, and then a strong recovery afterwards, and then the news flow starts to deteriorate as the virus spreads west. So sort of the closer things get to Wall Street, the more important they are. So the markets had already turned down before the Italian lockdown at the end of February. And we then get a precipitous collapse of global equity markets. I hope the sharpest and nastiest fall that any of us again ever has to see. And that was a full-blown market crash. And then coinciding right at the bottom on the 23rd of March, arguably quite late to the lockdown party, the UK. And the coincidence of the bottom of the market is not our lockdown. It's what the central banks were doing at the time, with central bank policy and action coinciding with government actions. But to understand this and put it into the context of the last decade, there's the US market for the last 15 years. And at this stage, I bring in Lenin. And Lenin probably features in too few investment presentations. But he said words to the effect of, sometimes nothing happens for decades, and sometimes decades happen in weeks. And what we have there is nothing happening for 10 years, and then all hell breaking loose in the space of 8, 9 or 10 weeks. And this is actually important, because that decade-long bull market was predicated upon dullness. It was predicated upon low, steady and predictable growth and inflation. And that enabled a large re-rating change in the valuation of global equities and in particular US equities. So the forward PE of the S&P rose in that decade from 12-ish to 20-ish. And we, along with everybody else, including the chap at the bottom of the screen there, were looking at the wrong dangers. We were looking for growth and inflation as the dangers, and they weren't. It was a virus. And this actually matters, because if that expansion of the PE and the rise of the equity market was based upon the predictability of dullness, we now have the complete opposite of that as the base case for the next decade. We've touched on the UK, so there's the UK equity market in the context of the US for 15 years. So you can see left-hand side of the screen, actually moving pretty much hand in glove for 2005 through to 2010, 2011. And then we've gone sideways and the US has gone 45 degrees upwards. So UK equity market is where it was in 2005, 2006. The US market, this is just focusing in on the last 12 months again, is back to where it was December-ish. So big underperformance over the last 15 years by the UK, and big underperformance during the bounce. As you can see, that red line has not risen very much. And there are some quite sound reasons for this, both the long term and the short term. The UK is what one might call an old economy market. If you look at the largest companies in the UK, they are typically oil companies and banks. They are still typically oil companies and banks. If we look at the largest companies in the US, then you know what they are. They are Apple, Amazon, Microsoft, Alphabet, Facebook, Visa. They are very different businesses. UK, we've all been talking about Corbyn risk for ages and ages, excuse me, and also Brexit risk since prior to the referendum in 2016, and Brexit risk is still prevalent now, very much so. And if you sort of imagine that you're sat in either Wall Street or Frankfurt or Tokyo or Shanghai and looking at the UK, I think it is quite reasonable to have the line of thought that the UK is 4% of global equity markets, a pretty small part, and it's got an awful lot of risk. Why should I actually bother with it? And that's quite a good question. But what actually scared everybody market-wise was this spike in the gilt yield. So this is yield on the UK 10-year gilt. You don't need to worry about the scale. What we have there is a very sharp spike as markets started to repeat the start of the credit crunch. They lost confidence briefly in the solvency of governments and was selling gilts and was selling sovereign bonds round the world. There was a run for used £20 notes and used $100 bills, and that, rather than the lockdown policies, is what prompted the central banks to act. And to their credit, act they did. And the stimulus packages that they have produced for us have been mind-boggling, to the extent that we now have the start of what's called helicopter money. So Rishi Sunak is giving us half-price fish and chips and a cheap new boiler. We'll come on to that also in just a second. But how big are these? Well, the US, $4 trillion or so. It's a big number. UK, we're at about 500 billion at the moment. The Eurozone, size of the rescue package, well in excess of 2 billion euros, probably closer to 3. These are extraordinary amounts of money, and the money has done the trick. Actually, it's worked in the short term because the banks have succeeded in stabilizing financial markets. Bond yields are all rock bottom. Equity markets we've seen, and the economies have stabilized too for the moment. But the extent of the economic damage is still very, very difficult to try to gauge. As we sit here this morning, the smart money is saying that the majority of developed and Western economies are going to shrink by between 5 and 10% in 20. That's a wide range. Of course, it's a wide range. But it's also important to try to understand how big an economic fall that is. If we look at GDP in real terms, then the states in the Great Depression, 1929 to 32, the US economy shrank by about 15%. So one way of looking at this is that lockdown is going to achieve in the space of 1 year, sort of between half and 2/3 of what happened during the course of the Great Depression of 29 to 32. There is really no overestimating quite what the economic impact has been. But let's come back to all that money, because surely that has to have consequences, and it might. But the range of views as to what the consequences are from depression on the one hand to boom on the other. So essentially, nobody has a clue. But how much money are we talking about? Well, in the UK, the annual growth of money currently is about 11%. If we looked at that in isolation, people would normally hold up their hands in slight horror and say the UK's got a big inflation problem. But if we look at it in the context of where the US is currently, US M3 growth at the moment, year on year, is in the region of 25%. Now, if it stays there, that has to have an inflationary impact. But that's a big if. It might not stay there. These are numbers that we all need to keep watching very, very carefully. But now let's come on to the opportunity and start to look slightly further forwards and with a more optimistic outlook. Because COVID brings tremendous opportunity as well as threat. And the UN's greatest systemic risk is not COVID or a second wave or a new virus. The greatest systemic risk is still climate change, and that has to be right. And the opportunity is to coordinate the response to COVID and an acceleration of the policies that everybody needs to decarbonize. And we all remember from what Greta Thunberg was saying over the last year, 2 years or so, that the climate change issue is actually not all that difficult. We know what the answers are, we know what's got to be done. The problem is that they are too painful and too difficult. What COVID does is to change that. What COVID does is to take the too painful and too difficult out, because it's got to be done to combat COVID, and make that decarbonisation possible. The challenge is exactly how many people and how many institutions will actually take up that opportunity to build back better. So we know what COVID has done. We know about the acceleration of digitalization, online shopping, working from home, localization, pedestrianisation, and just something as simple as electric vehicles. It changes the dynamics of that massively. Because if we all work from home so much more than we used to, then everybody is travelling less. And what were the obstacles of EVs? The obstacles were that their mileage range is a little bit short and there aren't enough charging points. But if we're just travelling to the office once or twice a week rather than 5 days a week and going to Tesco's, then that whole travel dynamic changes and EVs become a much more viable proposition. So every business has got to deal with both COVID and carbon, and the opportunity is to coordinate those two. And in both those transitions, there will be leaders and there will be laggards. And our job as investment managers is to differentiate between those two. And just as one very obvious example of that, there's Amazon.com, which we know is the #1 beneficiary, arguably, of online shopping. And there is Marks and Sparks, which is a business which just hasn't got online shopping. Marks and Sparks has actually got the carbon thing in terms of decarbonisation. It's a fantastic business. In terms of moving its retail business online, it's been hopeless. But sometimes that transition and that differential hasn't happened yet. So here we have BP and Exxon share prices from the start of the year. And BP is a business which is saying our future is not as an oil business. Our future is as a renewable energy business, because the oil business has no longer. Exxon, on the other hand, is saying we're an oil company and oil has got a future for decades to come. And at the moment, the market is not differentiating between those. At the moment, when we went through that oil crisis, when certain oil contracts went to zero, or actually minus 40 they got to, but the market had said an oil company is an oil company is an oil company. But the future plans of those two businesses are poles apart. And it would be wrong to say which one's right, which one's wrong, but the market will differentiate between those hugely. And so we come to the conclusions. What did we do in response to the virus? Well, in March, we decreased the risk of our portfolios. We went towards safer havens. We went to cash, we went to sovereign bonds, we went to gold, and we made quite a chunky reduction in our UK weighting relative to our overseas weightings. We put our first toe back in the water in May, and I stress that was just a toe. To get the whole foot back in, a reasonable expectation, I think, probably the whole of this year, and maybe into next. And absolutely, such a clear focus on the transition leaders rather than the laggards, both of COVID and of carbon. And that's going to take us a bit more outside of the UK too. So if you're looking at where we're finding those, a lot of our sustainable funds are absolutely focused on the transition leaders. It's taking us more and more to Europe. It's taking us more and more to the States too. And there are sort of selected businesses in the UK, and I just highlight one called Intertech, which is a quality control and testing business. So if you're looking at winners from COVID, to get businesses up and running and working again, they've got to know that they're doing everything right COVID-wise. How do you know you do it? How can you tell your workforce that you've got a big tick in your COVID box? You get Intertech to do it. It's a fantastic business and it's going to be a huge winner from it. And on that note, I thank you very much for your attention. And it is my pleasure to hand you on to the next talk, which is from my colleague James Clark. And whilst we do the transition, there will be another poll for you.
Ladies and gents, please vote now in our second poll. We'll just have this up for 10 further seconds. Excellent, good level of support for sustainable investment. Well, good morning, ladies and gents. Thanks for joining us this morning. My name is James Clark. I'm a fund research analyst here at Hawksmoor, and my section of our seminar this morning is on why sustainable investing is here to stay. We're going to touch on what we think is the link between COVID-19 and sustainable investment. We're going to have a look at performance in this area, supporting the UN Sustainable Development Goals. We're going to have a look at a campaign that's running at the moment and consider some counter arguments to this advance as well. And we'll wrap up with a look at Hawksmoor's Sustainable World proposition. But first, a look back at lockdown and some of the scenes that we've seen over the last few months. We have here a deserted Piccadilly Circus in London, some empty aeroplanes stacked up on the runway at Hong Kong International Airport, a lady working from home in continental Europe, some empty supermarket shelves over in the US, and just a reminder of some of the extraordinary scenes that we've faced over the last couple of months. But it hasn't all been negative. We've got here a couple of photos from India. In Delhi, the level of pollution in the air, considered most harmful to human health, fell by 60% in just a few days following lockdown. Elsewhere in the country, villagers could get clear views of the Himalayas for the first time in decades. So it hasn't all been bad. But why are we starting with this? Why are we almost reminiscing about lockdown, and what's the link with sustainable investment? Well, it's this. We think COVID-19 accelerates changes in behaviour and attitudes towards sustainability, which are already underway. This isn't new. COVID is the accelerant to this change, with even more focus on sustainability. So what does that look like? Well, hopefully these photos are just an indication of what we think we'll see. The overall point is about resilience and an increased move from the physical to the digital domain. The chief executive of Microsoft has recently said that the company's seen more than 2 years worth of digital transformation in just 2 months. We think we're going to see, and we're going to need, more capacity and resilience in IT systems, data centers, communications towers. We think there's going to be even more online shopping, communications such as this, online education as well. Linked to what Jim was saying, we think there's going to be less traveling for work, which will enable the quicker adoption of electric vehicles, but more sustainable travel choices when we do have to travel. Tied in with this, we think there's going to be even more appreciation of renewable energy and awareness of the environmental impact of using fossil fuels. Linked to that, there's going to be even more appreciation of efficiency in both domestic and commercial settings. Healthcare investment's going to need to continue to rise, covering everything from small items in the supply chain right the way through up to mission critical units in intensive care. And above all, as I say, resilience. So just a few things that we think we're seeing now and that we're going to continue to see in the near future and into the medium term. And the point here is that many sustainable investment strategies already invest in these themes and have done for years. In some cases, 25, 30 years for the longest established sustainable funds. But these themes are really just coming to the fore now, and there's more focus on them because of COVID-19. And we have here just a a snapshot of themes from just 3 of the funds that we invest in. The Lion Trust Sustainable Future range, of which we invest in 3, Vontobel Clean Technology, and Web Sustainability. So themes such as health, well-being, safety, building technology, resource efficiency, connecting people, improving the efficiency of energy use. So if these are the themes, then what kind of companies fit into these themes? Well, we have here just 2 examples. We could select a number of different ones, but time permits just 2 this morning. So we have firstly Daikin, a Japanese company which would fit into a theme such as improving the efficiency of energy use. Daikin is a global market leader in manufacturing efficient heating, ventilation, and air conditioning equipment. Air conditioning accounts for about 5% of residential energy use globally. Ventilation and cooling each account for about 10% of commercial energy use globally. So you can see there's a real potential for aggregate reduction in energy use by using really efficient centralized aircon systems that Daikin makes. The second example, a popular sustainable stock that you might well have heard of, particularly at the current time, Thermo Fisher Scientific, which would fit into a theme such as enabling innovation in healthcare. Thermo Fisher makes a laboratory and testing kit for a wide range of scientific disciplines. Their equipment was used to sequence the COVID-19 virus genome. One of their microscopes was used to show the first 3D structure of the COVID-19 protein, and the company's producing over 5 million diagnostic tests per week. So there's loads of popular sustainable stocks that we could show, but hopefully that's just an interesting couple of examples of the kind of companies that fit into these themes, which are really coming to the fore at the moment. And if those are the companies, then what about the funds that we invest in? And again, there's loads of really good examples that we could show, but time permits just one, and we've chosen Lion Trust Sustainable Future Global Growth, which is really one of our very top picks from the global sustainable equity funds, which we think are the strongest cohort available to UK investors. This range of funds invests in 3 broad themes: better resource efficiency, improved health, and greater safety and resilience. And therein, they've got 20 sub-themes. And as you can see, performance, particularly for this global equity fund, has been really strong, and particularly so over the last few years. This is a top quartile performer within its mainstream global peer group of funds over 1, 3, and 5 years. One of our very top picks. But sustainable investment is not just about researching a few funds, putting them together into a portfolio and saying, there you go, we can do sustainable investment. It's about allowing investors the opportunity to combine their investment objectives with their support for the UN Sustainable Development Goals, of which there are 17 shown here on the tiles, with 169 underlying targets. Now, I wanted to touch here on what the funds that we invest in are actually doing, because more and more funds are mapping their holdings and their investments to the support of the UN Sustainable Development Goals. For example, Henderson Global Sustainable Equity, one of our choices, maps their holdings to all 17 of the SDGs. Web Sustainability, another topic, invests in 9 impact themes mapped to 7 of the SDGs. Now, impact reporting, alongside investment reporting, is a nascent area. It's developing at the moment. Different fund management groups are progressing at different rates. Some haven't really progressed that much at all. Some have been doing it for 5 or 6 years. But the problem is that it relies on investee companies, portfolio companies, reporting the positive impact of their own goods and services. And in many cases, those are still estimated impacts rather than reliably measured impacts. We'd like to be able to offer this at the portfolio level, but it's still a challenge at the moment while it's such a developing area for the funds that we invest in, but we really would like to do so. But there are still some really positive impacts out there, and some groups are quantifying them really well. So I've mentioned web sustainability a couple of times. In this fund's brand new impact report covering last year, £1 million invested in the strategy would have supported the avoidance of 850 tonnes of carbon dioxide emissions, treating 11 million litres of wastewater, recycling 155 tonnes of waste materials, and providing healthcare treatment for 160 people. That's just a snapshot of the impacts that they report, by no means all of them. So these funds are really doing some genuine good. And that links to a campaign that I wanted to touch on. A very recent campaign launched just at the end of June, co-founded by Richard Curtis. Make My Money Matter, which is all about knowing where your pension money goes. And they have a really good tagline, pensions with intentions. So this is a campaign calling on individuals, governments, and organizations to invest their pension funds sustainably. It's basically a campaign encouraging the development of sustainable investment. And as such, it's highly aligned with our Sustainable World Service. They're encouraging exactly the same things as we are. So please do have a look online, Make My Money Matter. We want to help make your money matter. But what are some counter arguments against the rise in sustainable investment? We can't just present all the pro arguments. What about the con arguments? Well, there are two main ones illustrated by these pictures here. Firstly, a low oil price, which is a disincentive to invest in renewable technologies. When the price of oil is low, why not just continue using fossil fuels? The second photo here, is COVID-19 a diversion for governments and authorities, diverting their attention away from the transition to a more sustainable economy, a more sustainable way of life? Other factors here, supply chains. We know how important they are for companies and communities. Are they too big, too entrenched, too set in their ways in the old way of doing things? Can they adapt to a more sustainable way of doing things? And similar line of thinking on people's attitudes. Are some people's attitudes and behaviours too entrenched in the less sustainable way of doing things to move to a more sustainable world effectively? So it's important to consider the counter arguments for us, but for us, the positives massively outweigh the negatives. So that's all well and good, but what do we actually offer in terms of Hawksmoor's Sustainable World Services? Well, we do sustainable investment along two strands, if you like, bespoke discretionary and model portfolios. Firstly, on the bespoke discretionary side of things, everything is exactly the same as for what you might call a traditional portfolio. So managed by the same investment managers in the same offices, using the same framework, processes and procedures as traditional portfolios. We run a buy list of sustainable funds, investment trusts and direct equities, and we can cater for specific client exclusion criteria. On the model portfolio side of things, available via financial advisors on platforms, currently on 8 platforms. We offer 4 sustainable world models, as you can see here on screen, ranging from cautious up to equity risk. On the right-hand side here, a snapshot of our quarterly Sustainable World Investors Report, going out alongside clients' valuations to report on the sustainability side of their portfolios, if you like, touching on developments in the sustainable investment space and in the wider community, the wider area, and also a fund focus each quarter, as you can see on the second of these 2 snapshots. So if you haven't seen one of these and you'd like a copy, please contact either your investment manager or one of our sales team. So if that's what it is, how has it performed? We've been working in sustainable investment since the back end of 2016. And in March 2017, we launched an internal illustrative portfolio, which is really guidance for our investment managers when constructing sustainable portfolios. So this is the track record you can see here. It's our longest demonstrable track record in sustainable investment. As at the end of June, this portfolio was up just a smidge under 20% since launch, against 6.5% for the ARC Sterling Balanced Asset Comparator. So we've been building a really good track record. On the model portfolio side of things, our oldest sustainable world model portfolio, the moderate version, is 2 years old this week. And again, as at the end of June, the performance of this portfolio is up around about 7.5% against 2.5% for the same ARC comparator. So we're building a really strong track record. So coming to the end of my section, a recap. Hopefully we've presented a good case on why we think sustainable investment is here to stay and what we think is the link between COVID-19 and the rise of sustainable investment. We've touched on strong performance, supporting the UN Sustainable Development Goals. We've touched on the campaign Make My Money Matter. We want to help make your money matter So if Hawksmoor Sustainable World portfolios look like a good solution to you, please contact one of the team and we'd love to speak to you further about these services. Thanks very much. And I'm going to hand over to Ian by way of another poll.
Right, good morning, everybody. I'll give you another 10 seconds or so for your poll, and then we will make a start. Excellent. Okay, good morning. My name is Ian. I manage Hawksmoor's AIM portfolio service. The relevance of Pac-Man is that today we will be talking about the UK's video gaming industry, which is turning into something of a success story. But before we get on to that, I just thought I'd give you a quick update on our AIM portfolio service, particularly looking at performance over the past 12 months. Quick recap of what we do. So we run the service with a dual objective. We will only buy stocks that will qualify for business property relief and therefore be exempt from inheritance tax after 2 years of ownership. But beyond that, we're looking to put together portfolios of high quality UK smaller companies. So we're looking for sustainably high growth over the long term. And our big advantage in being able to do so is our own smaller boutique size. Means we can be far more nimble. So we can look for opportunities across the whole of the AIM market cap spectrum, and that affords a lot of opportunities. So, for example, we don't own Boohoo at all in any of our portfolios. For those of you who follow AIM and what's been going on recently, I mean, Boohoo's down about half this quarter. We don't own it, and that has been to the benefit of our clients. That nimble approach. You don't need to take my word for it. We have been awarded the best AIM IHT portfolio service for 2019-20. If we look at performance, this is the longer term chart, so going back to 2015, and you can see this has been a good market to invest in. Over the past year, however, that's turned rather volatile, as you can see on the far right of this chart. If we break that down into quarters and look at those three on the right, we had a very good end to 2019. So our portfolios were up about 20% in the fourth quarter of 2019. If you can remember that far back, people were talking about the Boris bounce. So it was off a higher base. But then rolling into the new year, particularly moving into March with COVID-19, the lockdowns, all of the economic uncertainty that brought, there was a pretty indiscriminate mad dash for the exit in AIM, and you can see that. So our portfolio was down by a third, as was the wider market. It was indiscriminate selling in the sense that everybody wanted to get cash, regardless of a company's economic sensitivities, lockdown sensitivities. But moving into the second quarter, so April, May, June, as a little bit more level-headedness, more sense kind of came back, so too did some of these share prices. So we were up 20% or so in the second quarter, which is about 5% better than the wider market. I think because we've always invested relatively defensively, so we like to invest in established businesses that are cash generative, that are in good financial health, and those are exactly the kind of companies that you'd want to own in a crisis. But while there is a lot of uncertainty out there, and there's a lot of economic difficulties for a number of businesses, a number of sectors, a number of individuals, there are also beneficiaries of lockdown and the current situation. So I wanted to spend some time this morning exploring one of those sectors, one of those themes, which is the UK's video gaming industry. And the first thing to note is that this was an industry that was already growing quite fast. So a 9% compound annual growth rate forecast for 2018 through to 2022, whether it's on your smartphone, your console, your PC, your tablet, people are consuming a lot more games. So anecdotally, we know last year, for example, the value of games sold surpassed the combined value of film and music for the first time, and that continues to grow. We know that games are played in 7 out of 10 UK households, but of course, with lockdown and enforced confinement, what that's done is to introduce a whole new audiences to the hobby, some of whom will stay. So, for example, Codemasters, which is a developer of racing games, who we'll come and talk about a little bit later, they have reported a doubling of their daily active users during the last 3 months, because a number of other entertainment outlets were of course shut off. It also turbocharged the rise of esports, which was bubbling away in the background, but has really been accelerated by lockdown. So esports is the practice of watching other people play video games. So for example, with football matches cancelled or postponed, Sky Sports instead were showing the E-Premier League Invitational, which is where you're watching Sky Sports, you're watching professional footballers play the latest FIFA game against each other. And that got 150 million viewers. So we seem to have moved very, very quickly from watching other people playing games as quite a niche, quite a fringe activity, to mainstream Sky Sports entertainment. And just, I guess, underlining this is the World Health Organization, who ran a campaign called Play a Part Together back in April, which was promoting games as a way for people to stay socially connected amidst social distancing. So I would argue that this whole period has almost upgraded the societal or the cultural value of games and how it's seen, from a socially isolating activity to something that socially connects instead. The next thing to note is that video games is something that, as a nation, the UK is quite good at. So this is a map of where the UK's developers and publishers are based, and you'll notice that this is a UK-wide effort. So there are big hubs in places like Leamington Spa or Guildford or Crewe. So the sector employs 15,000 developers, so high skilled jobs. 15,000 makes it one of the largest video gaming sectors in Europe, and 55% of those jobs are outside of London. So this is a nationwide effort. Grand Theft Auto 5, which is the most successful entertainment product of all time, sold over $1 billion in its first 3 days. The team behind that are based in Edinburgh. So video gaming is a UK success story. The investable opportunities for us, particularly within our AIM portfolio service, are also increasing. So these are 5 listed developers or gaming stocks, all of which are listed on AIM. 3, so Frontier Developments, Codemasters, and Sumo, all listed within the last 3 years. Keyword Studios is quite a big company now. It's £1.5 billion, and we would expect this opportunity set only to increase, partly because this is a growing market. It's also a consolidating market. So as supply chains become more mature and more complex, scale begets scale, and there will be some decent sized businesses which may choose to list. But the main thing I wanted to talk about in this section was that the investment case for this sector has also dramatically improved because of the digitalization trend. And all I mean by that is moving from selling games as a disc in a box from a retail store to selling games via a digital download or subscription service. So we can see that this has been a trend that's been in motion for several years. The bar chart on this slide shows the case of Codemasters. So back in 2014, 80% of Codemasters' revenues came from boxes sitting on shelves in retail stores with a disc in. As of last year, that was down to just 30%. So almost 70% of their sales now can come digitally. But these are March year ends. So what lockdown has done, with enforced confinement making it far more difficult to go out and buy a physical game from a retailer, it's going to have accelerated this trend, probably quite close to 100%. It is far more easy to access your games digitally during lockdown than going out and buying them. But why that's important is digital-based sales are much better propositions for the developers, because you cut out an awful lot of cost and complexity. You don't have an inventory to worry about. You don't have anything to manufacture or to ship. You don't have to employ somebody behind the checkout to sell that game to you. So it's a much higher margin proposition. And second of all, it increases the longevity of these games, because whereas a selling space in a physical shop is limited, online it's not. So that means that you can monetize your back catalogue of games for a much longer period of time, and that improves your, the recurring nature of your revenues, and also the quality and the visibility of your earnings too. But developing a AAA blockbuster video game is still a risky endeavor. So Codemasters, they employ 500 developers. It will take them 2 to 3 years, 20 to 30 million pounds of investment to develop a next blockbuster game. And they will make most of the money from that game in the first 6 to 9 months after it is released. So there's a lot of upfront investment, and there is always the risk of a game flop. So one way of sidestepping that risk is to follow more of a picks and shovels approach, if you like, with someone like Keywords, because Keywords is not a developer, rather it provides services to the wider developing industry. So for example, if you have developed your game, you would go to Keywords to have it translated into Japanese or Korean or whatever to access those markets, rather than having to employ Japanese or Korean translators yourself, which doesn't make any sense. And as this industry matures, becomes more and more complicated, that trend to outsourcing is well entrenched. So we said before that the wider market is growing at 9% a year. Keywords on an organic basis is growing at almost twice that. It's growing about 15% a year, or did last year anyway. So the pie chart on this slide shows all the different services that they provide, whether it be like localization or doing the art or marketing, even some actual game development. So it's a wide service offering to the industry. In lockdown, incidentally, most of this transfers quite well to home working. The one area that doesn't so well is audio services, where you need quite specialist equipment. You need studios and all that kind of thing. But their experience of lockdown is that demand for content just far outstrips supply, what they can provide, because there's an awful lot of gamers out there demanding content, an awful lot of developers wanting to get content out to them. So they have been extremely busy. And then final point is that we are on the cusp of the first new console cycle since 2013, and this is likely to be a near-term catalyst for the industry. So we have the PlayStation 5, we have the new Xbox due out later this year. Typically what that means is faster speeds, better graphics, all that kind of thing means a lot more activity, new games coming out, a lot more demand from players and from the development companies. We're also starting to see the end of the console cycle entirely with Google's Stadia. The way this works is instead of having a piece of hardware, the console in your living room, instead it is sat on Google's servers, and you stream your games over the internet. And then the final thing to mention would be virtual reality, which is the single fastest growing area within video gaming. It is quite clearly demonstrating that prices are getting exponentially cheaper, and the hardware is getting exponentially more advanced at the same time. All of this is just really good news for the developers, for keywords, because it's more outlets, it's more activity for their content. To conclude, we've seen that video gaming is a UK success story and a UK-wide success story, and also that the number of investable opportunities into that sector are increasing, especially on AIM. I would argue the sector is a beneficiary of COVID-19, not just because it's introduced new audiences in these past few months, but also I think because it's upgraded the cultural, the societal value of gaming. It's turbocharged esports, for example. Then we talked about digitalization, how that dramatically improves the investment case by enhancing the margins, improving the longevity of games. And then finally, as a near-term catalyst, we have the new console cycle about to be upon us. I can't do a talk on AIM without wishing it a happy 25th birthday, which it passed a couple of weeks ago. I think the main point to make here is, AIM has matured considerably over those 25 years. Not just that it started with 10 companies and now there's close to 800, but also the quality of company that you can find on AIM has also dramatically improved. It is a great place to invest. There are a number of really very high quality UK smaller companies that we are keen to buy. So I'm going to end it there. Thank you very much for listening. The only final thing to say is, if estate planning, inheritance tax planning, AIM portfolios is something that you advise on, please come and find out more about our service. I'm going to hand you over to Sarah for some Q&A. Thank you.
Ian, thank you very much indeed. Absolutely fascinating. And as somebody who doesn't know anything about video gaming, I have certainly been enlightened today. I'm very conscious that we're coming up to 12 o'clock, and I know if you're anything like me, you're possibly jumping on to other Zoom calls. So we'll try and keep the Q&A to a minimum, but we do have a couple of questions. And perhaps, Jim, you would like to let us know what you see as the outlook for deflation or inflation over the next 5 years. Do you expect central banks to be able to achieve their targeted inflation or to lose control and exceed it?
I wish I had a crystal ball to be able to answer that one. I don't know is the honest answer. The range of inflation possibilities for the next 5 years ranges probably between sort of low single-digit deflation and mid double-digit or sort of mid-teens inflation on the upside. And I've never known a time when such diametrically opposed outcomes are both on the entirely reasonable end of the spectrum. So my completely honest answer is I don't know, and we're watching it extremely closely. Either way, the genie is out of the bottle, and that 10-year period of very stable inflation has gone, and that 10-year period of very stable growth, and that was what underlined that 10-year long bull market. The outlook for the next 10 years is completely different. It's that up and down.
Thank you. Jim, if you can cope with that, I've got another question for you here. With all these changes, will the big oil companies still play a important part in portfolios?
Another terribly good question. Generically, we are trying to reduce our exposure to oil. It's traditionally been a large part of private client portfolios, primarily for the income. What the income outlook for the oil companies is for the next 5 years is very uncertain, and it's certainly not as good as the last 5 years. And for us, probably the defining moment for the oil industry is going to be September's conference by BP, in which their new chief executive, Bernard Looney, lays out BP's transformation plans. And that will give everybody a much clearer roadmap of how easily, how difficult it's going to be for the oil companies to transition into being non-oil companies, and what level of income they're likely to be able to produce while they're doing that, and how expensive that transition is going to be. So, come back to a much shorter answer to that. Oil companies will play a diminishing role in our portfolios over time.
Good, thank you very much indeed. We've got a few more questions coming in, so assuming most people are still good for time, perhaps a question for Ian. Do you think it's likely that business property relief will be taken away from AIM shares? And if so, what are the attractions of investing within AIM?
It is certainly a risk that business property relief is taken away from AIM shares, and is something that the financial press likes to talk a lot about up before every single budget, it seems. I actually don't think it's likely that that the government would take BPR away from AIM shares, because the benefit that the Treasury gets, certainly the indirect benefit, is considerably greater than the foregone inheritance tax, because essentially what BPR is doing is it's incentivizing investment into the UK's smallest companies, UK's smallest growth companies, which in turn is creating jobs, creating factories, creating economic output, and all of the tax benefits that the Treasury can get from that, I think is far greater than that lost inheritance tax. But nonetheless, it is certainly a risk. The way to mitigate that risk is to make sure that your portfolios can stand up on their own investment merit. Quite apart from the inheritance tax benefit, the BPR benefit, it's assembling portfolios of quality companies where the price makes sense, and that's something that we endeavour to do.
Fantastic, thanks Ian very much. Jim, I'm going to pop one more question back to you, and then I think we should wrap up. I know we've still got quite a few people on the call, but I don't want to exceed our time. Some countries now have negative base rate, Jim. What would the market effect be if our base rate went negative?
I think it would be taken very badly. I think negative interest rates in the UK would achieve the opposite of what they're designed to do, which is to get people spending. I think it would be a signal that people need to hoard their money rather than to spend it. It would be desperately expensive for the banks and for the building societies. So I think if the Bank of England moved bank rate below 0, I think that the equity market would fall, and quite sharply, which is one of the reasons I don't think that the bank's going to do it.
Thank you. One last question, and then I think we'll wrap up. Jim, sorry, I'm afraid it's for you again. As long-term investors, we would have expected you to have taken advantage of falls in the market. How are Hawksmoor investing at the present time?
We have our first toe back in the water. So we've made our first tentative increase in our equity weights. But generally, we think an awful lot of share prices have risen far too fast, partly as a result of all the money printing that's been going on. There's a lot of money chasing too few attractive assets currently, and there are too many share prices discounting an extended V shape. And I think we're going to get plenty of opportunities to be able to buy the companies that we want to buy at better prices than we're currently seeing. So I think phased over the second half of the year is the minimum time period that we would expect to get back in.
Brilliant. Thank you, Jim, very much indeed. So in order to wrap up, I'm actually going to look at a question that was asked at the beginning of our seminar, which was basically, how has COVID impacted on the industry, affected life at Hawksmoor, and what does a post-COVID Hawksmoor look like? And this really ties into the sustainability approach, because as we move to working from home, it means we are doing, as has been referred to in all our presentations, our virtual meetings, hence the virtual conference today, virtual meetings with our advisors and our clients, which will help with sustainability. We are implementing an online portal, so we will be able to deliver and communicate with everybody not only more efficiently and securely, but also much more sustainably, because we won't be printing half the Amazon rainforest or using carbon fuel for Postman Pat to drive around the country to deliver valuations and everything. So we are making strides, and thanks to the situation we find ourselves in, we are accelerating these. So we will give you more information imminently about that. So it's finally wrap-up time, and I would just like to say it's been a huge pleasure to host this conference today, and I thank you all very much for attending. I hope it's been of interest. I hope Jim made sense of world markets in these very strange times. There is no doubt sustainability is here to stay, and I think James made a very elegant explanation of where we are on investing sustainably. Ian, fascinating insight into the video gaming industry, and also a very happy birthday to AIM. As you've probably seen in the top right-hand corner of your screen, this has been recorded, and the recording will be available on our website. And suffice it to say, if you are looking for a CPD certificate for this event, which you are entitled to receive, please make sure your details are with Jill, and she will be able to send it on to you in due course. And last but not least, the good old feedback form and Survey Monkey, if you could complete that, we would be incredibly grateful. Apologies for the blip with the poll right at the beginning of the session. Technology, as always, is what we are reliant on, but we just about got there. So thank you all very, very much for attending. Sorry we've gone a little bit over, but I hope it was worthwhile. Thank you and good morning.